Hello, Savvy Savers! You've tuned into House Lux Estate, your go-to channel for mastering your financial universe. Here at House Lux Estate, we're dedicated to offering you the most practical and insightful financial tips to help you navigate through the complexities of managing money. Today, we're peeling back the layers on a topic that champions personal growth and financial independence: financial maturity. Understanding this can significantly influence your long-term success and stability. Stay with us as we dive into the 10 signs that you are financially mature. First up on our financial maturity checklist, budgeting. Imagine your finances as a complex machine. The budget is that essential tool that helps keep all the gears turning smoothly. It's not just about limiting spending, it's about empowering yourself to make informed financial decisions every day. By setting a budget, you essentially map out your financial landscape, which highlights your spending habits, savings, and even those sneaky, often overlooked expenses. Now consider the power of visibility. When you track your expenses, you're less likely to overspend and more likely to spot opportunities to save. Think of it as having a financial GPS that keeps you on the right path, steering clear of unnecessary detours and pitfalls. Furthermore, a budget isn't static, it adapts. Life changes, and so should your budget. Whether it's planning for a big vacation, preparing for a new family member, or adjusting to a new job, your budget is your financial blueprint for the future. So, if you're diligently following a budget, you're on the right track to financial maturity. Next, let's talk about the safety net every financially mature person needs: an emergency fund. An emergency fund is essentially a financial buffer that can help you manage unforeseen expenses without derailing your regular budget or sliding into debt. Think of it as your financial airbag, cushioning you in case of sudden job loss, medical emergencies, or urgent home repairs. Why is it essential? Well, life loves throwing curveballs, and having this fund keeps those surprises from turning into financial nightmares. It provides peace of mind, knowing you won't have to scramble or make drastic decisions under pressure. So, how much should you save? A good rule of thumb is to aim for 3 to 6 months' worth of living expenses. This amount gives you a robust buffer while you find new employment or deal with unexpected bills. Start small if you must, and gradually build it up. Remember, it's not about the speed, but consistency in your savings. Having this fund means you're prepared for life's unexpected twists. Handling debt wisely is another crucial sign of financial maturity. When discussing debts, it's vital to recognize that not all debts are created equal. There are generally 2 types: good debt and bad debt. Good debt can be considered an investment that will grow in value or generate long-term income. Think mortgages or student loans. Bad debt, on the other hand, typically includes high-interest credit cards or personal loans that don't enhance your financial position. Now, managing these debts requires strategy and discipline. 2 popular methods are the snowball and avalanche methods. The snowball method involves paying off the smallest debts first, gaining momentum as each balance is cleared. This can be incredibly motivating as you see the number of debts diminish. Conversely, the avalanche method prioritizes debts with the highest interest rates. While it may take longer to see the reduction in the number of creditors, this method can save you more in interest over time, making it highly efficient financially. Master your debts, and you master a part of your financial destiny. Are you thinking ahead? Let's discuss saving for retirement. Imagine a future where you can enjoy your golden years without financial worry. This isn't just a dream, it's achievable with early retirement planning. Starting to save early harnesses the power of compound interest, where your money grows exponentially over time because you earn interest, not only on your initial deposit, but also on the interest that accumulates. The sooner you begin, the less you have to save each month to reach your retirement goals. For example, starting in your 20s might mean setting aside a smaller percentage of your income compared to starting in your 40s, when you might need to save aggressively to catch up. Think of retirement savings as paying your future self, whether it's through a 401(k), an IRA, or any other retirement account. Consistently contributing even small amounts can lead to significant growth over decades. Contributing to a retirement fund is a surefire sign of financial foresight. Investing isn't just for the wealthy, it's a mark of financial maturity. Let's navigate the landscape of investment, starting with the basics. Investment is essentially the act of allocating resources, usually money, with the expectation of generating an income or profit. This can take many forms, from stocks and bonds to real estate and mutual funds. Understanding the types of investments is crucial. Stocks offer a piece of ownership in a company, while bonds are akin to loans made to a corporation or government, with the investor acting as the lender. Real estate investments involve purchasing property to generate rental income or capital gains. Mutual funds, on the other hand, pool money from many investors to invest in a diversified portfolio of stocks and bonds. Diversification is another key principle. It's the strategy of spreading investments across various financial vehicles, industries, and other categories to minimize risk. By not putting all your eggs in one basket, you reduce the impact of a single failing investment on your overall portfolio. Understanding investments enhances your financial stability and growth. Let's shift our focus to credit health. A credit score is like a financial report card, showing how well you manage your money and debts. It's calculated using several factors, including your payment history, the amounts you owe, the length of your credit history, new credit applications, and the types of credit you use. Why is a good credit score important? Well, it affects your ability to borrow money and the terms you get. A higher score can lead to lower interest rates on loans and credit cards, which means you pay less over time. It also influences your capacity to rent a home and sometimes your job prospects. Maintaining a good credit score involves making payments on time, keeping credit card balances low, and being cautious about opening new accounts. It also means checking your credit report regularly for inaccuracies that could drag your score down. Keeping tabs on your credit score is a sign you're in control of your financial health. Setting and achieving financial goals is our next sign of maturity. Imagine financial goals as the roadmap of one's financial journey. Starting with short-term goals, like saving for a vacation or paying off a credit card, these targets are usually achievable within a year and provide immediate satisfaction and motivation. They're like the mile markers on a highway, showing you're on the right track and moving forward. On the other hand, long-term financial goals require more patience and discipline. These might include saving for retirement, buying a home, or funding a child's education. They are the destinations on your financial roadmap, often taking several years to achieve. Having these goals in place does more than just provide a checklist of financial achievements. They help in guiding everyday financial decisions. Each choice made can be aligned with these goals, ensuring that every dollar spent or saved serves a purpose towards reaching them. Goals give your financial decisions purpose and direction. Are you protected against potential financial losses? Let's talk insurance. Insurance isn't just a piece of paper you begrudgingly pay for. It's a crucial layer of protection that shields you from unexpected financial turmoil. Whether it's a sudden illness, an accident, or a natural disaster, having the right insurance policies in place can be the difference between a minor hiccup and a financial catastrophe. Firstly, health insurance is imperative. It covers medical expenses from routine checkups to emergency surgeries, preventing medical bills from draining your savings. Next, there's life insurance, offering peace of mind by providing for your loved ones in the event of your untimely departure. It ensures that they'll be financially secure and can maintain their standard of living. Lastly, let's not overlook property insurance. Whether you own a home or rent, property insurance helps cover losses to your physical assets due to theft, fire, or other damages. Adequate insurance coverage is a responsible financial move. Regular checkups aren't just for your health. Like visiting a doctor, conducting regular financial reviews is essential to maintaining and improving your financial wellness. It's all about checking in to see if your money is working as hard as you are. Imagine your financial plan as a roadmap. Over time, road conditions change, detours pop up, and sometimes you discover a new destination altogether. That's why revisiting your financial strategy every few months can make a significant difference. It ensures that your investments, savings, and spending align with your ever-evolving life goals. During these reviews, ask yourself, are you closer to achieving your financial goals than you were a few months ago? Have your financial circumstances changed? Perhaps you've received a raise, paid off a significant debt, or faced unexpected expenses. Each of these factors could warrant adjustments to your financial plan. By taking the time to regularly assess your financial situation, you empower yourself to make informed decisions that keep you on the path to financial maturity. Keeping a close eye on your financial health is key. Last but not least, financial literacy. Let's dive into what it truly means to be fluent in the language of finance. Financial literacy isn't just about knowing how to balance a checkbook or understanding your bank statement. It's about grasping a wide array of financial terms and concepts that influence your everyday life. Imagine understanding compound interest well enough to see how it affects your savings, or the inflation rates that might be nibbling away at your purchasing power. It's about knowing the difference between stocks and bonds, the implications of a mortgage, and even navigating the complexities of taxes. But financial literacy goes beyond just understanding. It's about applying this knowledge to make informed decisions that pave the way to financial stability and growth. Continual education on financial matters is crucial. Whether it's reading articles, attending workshops, or simply engaging in conversations about finance, every bit of new knowledge contributes to your financial maturity. Staying informed is the cornerstone of financial maturity. And that wraps up our top 10 signs that you are financially mature. From setting a personal budget to understanding your credit score, each sign plays a pivotal role in solidifying your financial foundation. Cultivating these habits isn't just about money management, it's about securing a future where financial independence and security are within your grasp. If you found this video helpful, subscribe to House Lux Estate for more insightful content. Remember, your financial journey is worth mastering.